Is the private equity industry sputtering? Over the past few decades, we've got used to buyout barons swallowing up vast numbers of companies financed with large quantities of debt and then selling them on at a profit. The private equity party reached its peak in 2021 as the pandemic rebound, combined with cheap leverage, sparked a wave of transactions. Since then, however, the landscape has changed. Higher interest rates have lifted the cost of debt for buyouts, while stock market investors have become increasingly skeptical of private equity-owned companies. The result is a kind of pig moving through a python. Private equity funds trying to digest large quantities of deals, but struggling to find buyers who will give them the valuations they expect. Meanwhile, the limited partners, these are the pension funds, endowments, and other investors who provide the capital for private investors, have been reluctant to invest in new funds while they're still waiting for returns on the old ones. So this week on The Big View, we're going to go under the hood of the private equity machine. It's what we do at Reuters Breaking Views. We tap our best sources around the world for fresh insights into business, finance, and economics. I'm your host, Peter Tharlassen, coming to you today from my home studio in northwest London. And in a moment, we're going to hear from this week's guest, Seth Boro. Seth is a managing partner at Thoma, Boro, the San Francisco-based firm which specializes in software and technology companies. Originally from Canada, Seth has been at Thoma Bravo for 20 years and has been involved in the buyouts of companies including Darktrace, Flexera, Ping Identity, and many others. But before we hear from Seth, we're going to hear from Jonathan Guilford, who's Breaking View's US editor and our resident North American expert on private equity and other alternative assets. Jonathan, welcome to The Big View.
Thanks, Peter. Good to be here.
So Jonathan, it seems like private equity has been a bit quieter in the past few years than it has been over its history. Is that, do you think, a reflection of some of the trouble that the industry's been having?
Yeah, definitely. It's funny because you think about what we've been through in the past few years, right? And during that 2020, 2021, like post-COVID excited bounce back cycle, everything was really expensive, right? Like stock markets were at like crazy highs, like valuations were insane, like, you know, kind of all these businesses that seem like bubbly or frothy or outright fake got these like just massive, massive price tags put on them. And then you had 2022, 2023, where valuations came back in, everybody maybe got a little bit cooled down by the interest rate hike cycle. And yet, you know, the kind of private equity industry as a whole ended up being totally pro-cyclical through those two times. So you had a ton of deals getting done when everybody was losing their heads, and then almost no deals getting done after that in kind of the long hangover.
Yeah, and this sort of conundrum with these funds filled with deals that they can't get out of, and the limited partners who provide the money saying, well, hang on, if you're not going to return any money to us, we're not going to help you raise a new fund. And so there's a sort of bit of an impasse there, isn't there?
Yeah, exactly. And so you start to see all of these, let's say, creative solutions to the LP cashback problem arising. And at Breaking Views, we've written a ton about continuation funds or oddball ways of putting leverage on private equity portfolios, or, you know, the rise of deals between private equity firms instead of deals that take assets out of the private equity ecosystem entirely. So folks have been trying to figure out how to muddle through that. And I think what we're seeing now is, everybody's hoping like, okay, maybe we're going to be in a bit of a period of normalization. You know, we've got AI, maybe a tailwind to the market and so on. We're maybe finally going to get IPOs coming back, especially in tech, where private equity tends to be somewhat overweight versus the rest of the market. But obviously, you know, that's still a thesis to be proved out, right?
Yeah, but it's very interesting to get a chance to sort of talk to someone who's on the inside and you know, dealing with all of this. So tell me why you thought Seth would be a good person to sort of explore some of these questions with.
Well, so Thoma Bravo is really one of the premier, like, absolute tech-focused private equity firms. And it's interesting because we actually spoke with Seth on the podcast back in 2022, back when we were in the previous phase of this kind of like three-step cycle, right? Like boom, bust, and then this oddball kind of volatile AI-driven return. And it's curious because Thoma accounts for an extremely large share of software and mainline tech deals that are done by private equity in the United States, even though they're maybe not as much of a household name as an Apollo or a Blackstone or a KKR. So it feels like they're really getting a good look in on the kind of like bleeding edge of what's happening in terms of deal flow, in terms of exit activity. And, Thoma, while there was a big slowdown in deal volume over these past few years, Thoma was one of those few firms that just kind of kept rolling on. And it did it with these kind of oddball deal structures that were like super heavily equitized backstops and all this kind of stuff. So Seth, I think, had a really good perspective on what was changing throughout all these different periods that we've identified.
Okay, let's listen to your conversation.
Seth, welcome to The Big View. It's great to have you here.
Thank you for having me back.
Yeah, no, so we actually last had you on the podcast all the way back in 2022, which at this point is so long ago, it feels like a totally different era. We're only halfway through what turned out to be an extremely aggressive rate hike cycle. We were stuck in a brutal equity market downturn that was still months away from bottoming, and neither of us nor anyone else had heard of ChatGPT yet. And so in the time since then, aside from you becoming a co-host on Thoma Bravo's own Behind the Deal podcast, it seems like you guys mostly just kind of kept chugging along on pretty much the same deal cadence throughout that time. So do you maybe want to walk us through what's happened with Thoma since our last chat, especially when it comes to your remit in the firm?
Sure. Well, we like to stay busy over here. And as you said, we have kept chugging along. We continue to be focused on investing in enterprise software as our main business. We have raised new funds since we last spoke. We're now investing out of our Fund 16 and in our flagship fund. We've raised a fund in Europe to just focus on the European software market, which we're really excited about. And the strategy has remained the same despite all of the changes you mentioned and the fact that AI has taken over the world, it seems.
Right. And so since we started off with a trip down memory lane here, it's probably worth thinking through like all the steps it took to get from there to here. Because if you take the last half decade, it feels like it brackets simplistically into three sort of separate periods. We had the post-COVID, post-lockdown, euphoric kind of boom cycle. So easy credit, high valuations, really just historically like enormous deal volume, right? Then the rate hike cycle, tight credit, tumbling valuations, but kind of paradoxically low deal volume. And now we're in this emerging from the woods, like you said, very AI-supported period that's maybe a bit more unpredictable, but kind of an in-betweener in terms of capital availability and price tags. Is that roughly about right, or does it look a bit different from your seat?
Well, you're right. We did go from a free money world where there was just a tremendous amount of deal volume to one that became a lot more measured. I think you especially see that in our industry, where look, certainly private equity has become more risk averse, and there's many different reasons for that. I think what we see today, at least from our side, is that our strategy, the Thoma Bravo strategy of partnering with incredible innovators and delivering results, investment results, and operational results through just incredible operations with great leadership. That strategy has remained the same. So from our perspective, and you see it because we've been very active buyers, we've been buying through that cycle. Now, as it relates to the industry, I do think that it's harder to raise money. I do think that there's been there's been less transaction volume, maybe not as a result of the fact that that credit is an issue, because it certainly isn't. And look, in our case, the credit markets, the fact that rates have gone up, of course, they've recently started to go down again. That's never been a driver of deal volume for us. Our capital structures are not very levered, so the cost of debt in and of itself doesn't really drive whether or not we're making an investment, and is usually a very small part of our return profile when we go sell one of these highly innovative tech companies. But I do think the industry has it's slowed down, and you see it. And I think there's more risk aversion. And I think that there's less buyers perhaps than there used to be. And I think we're going to continue to see that.
Hey, let's push a little bit on that. I'm interested about the idea about like the difference or lack thereof that credit availability makes, because I mean, Thoma definitely kept up, I think, like a very strong deal cadence throughout even that really like tight credit period. But you look at kind of what was released in like deal agreements and whatnot, then you saw, I think, a lot of folks were surprised by how aggressive you guys were willing to be to, for instance, backstop an entire agreement with equity or, kind of do whatever you needed to do to get stuff down the line. I presume, is it the case, like, if you take those three buckets, right? So, like, the deals in the very, like, loose credit period, the deals in the middle, and now, like, you end up managing those on, like, a company level to, like, roughly similar cap structures by maturity? Or is it something that you, like, manage on, like, a kind of, like, fund vintage level? Because, like, there are differences there, right?
Well, I think actually, if you looked at our investments across the cycle, they would look really similar to you. Actually, the thing that sort of went away in the market, in our market, is that you had at a period of time in software, which is where we invest, you had lenders that were willing to lend just on recurring revenue, but at very, very high multiples of that revenue. That's changed over time. Today, we're in a much more normalized lending market. You have both the syndicated markets and the credit markets in a relatively healthy, the private credit market, sorry, in a relatively healthy place today. It's much more focused on cash flow and business fundamentals than it is lending money to companies, on essentially a revenue multiple that were excessive, right? Like that piece of the market has gone away, and I think for us that's great. I think that we never relied on that. Of course, for the companies where we thought it made sense, we took those financing packages if they were the best available, but only if we thought we could support them. And I think what ended up happening is that you had some companies that were very slow growth, actually, getting the same recurring revenue loans as very high growth companies. And so the high growth companies, at least the ones where we took those loans on, they sort of grew into that credit structure. You had many that did not. And I think that's where you're going to see in the market over time, some financing issues. And look, the industry is not there anymore. But if you did look across our portfolio, what you would see is capital structures that across that whole cycle were very heavily equity focused. We are in many ways in the growth buyout business, even though we're private equity and we are control investors. Most of what we're doing is what we consider growth buyout, and in growth buyout, 70% of your capital structure is going to be equity. And so that's very typical for us, and you'd see that being relatively consistent, across this time period that we're talking about.
Do you think that's something where the brackets on those definitions have like changed at all over the last few years? Because I feel like that's what everybody feels like in a bunch of other like slices of the private equity world, right? If you like step over into like infrastructure or whatever, and like the aperture changed a lot, or if you move like kind of up and down the risk stack, like things like got a little bit looser in definition, especially when people were in like not a target rich environment and they really needed places to put capital. Like, has that same kind of creep happened, do you think, within like kind of growth equity, within that kind of like technology bucket, or has it all stayed fairly like on the rails?
If you're referencing my comment on us being a growth buyout investor, that's been for us the way we've been for the last 15 years now, right? You can't be an investor in software in the world where we are from a valuation perspective, and the valuations have been there for a long time, and not be in the business of innovating, buying growth, backing teams to increase growth while also increasing profitability and consolidating markets. Like that's what you need to do if you want to generate the kinds of returns that our investors demand. There was a time in software many years ago when I first started 20 years ago at this point, where it was a deep value market. And in that deep value market, you could make your return off cash flow and a decent capital structure. That doesn't generally exist anymore today. And so it's all about operating these great companies with great leaders in great sectors. And that's what we're in the business of doing. It's the reason that you see us buying these marquee names in enterprise software, right? If you look at the composition of our portfolio companies across all of our funds, these are just incredible businesses. They didn't exist to buy when we first started. It wasn't a market where, A, we had the capital to do it, and B, where, we could really get the attention of management teams in many cases. And that's completely changed because, companies, management teams, great leaders in this market, they see what a partnership with us can do, just in terms of, not only providing capital, which is really important, in speed and the ability to make very, very quick strategic decisions. You look at kind of the book of work over time, and some of the companies that have come out of our portfolio are highly, highly strategic, and some of the best businesses that you can find in their specific sectors. So I'm not sure that there's been any wholesale change in industry. This has been our strategy for a while. We've adapted with the market and the times. And you live in a world today, just valuation-wise, where you need growth to get your return. It's just the reality. And that's the world we've been living in for quite some time now, actually, in software.
Yeah, because I feel like the story during that low valuation, but also low deal volume period was everybody was expecting that the bid-ask spread would eventually collapse there, right? And that never really seemed to happen. So we never really had the price reset that I think a lot of people thought was going to change, like in the aggregate, what these kind of portfolios look like and maybe bring down multiples across the industry, which
Totally.
it's kind of difficult, right? If you're like an incumbent manager and you've got a book that you were hoping would kind of like maybe like season down to like a more kind of like moderate level of marks throughout. Like, is that a challenge? Because I would imagine everybody is still tied somewhat to like quite a heady period in like 21, even kind of like early 22, right?
I think we're still seeing it today. It's a really good point. There's a bid-ask spread in the private market still. And I think some of that is related to those 21, 22 deals where there was a really high price paid, and there could be a great asset there that should be traded. But the owner, the buyer, the owner is not getting the return, that they need based on the price that they paid, even though the company's performed. So we've seen that recently where, what we might think is a full price in the private markets for an asset, and what the seller is willing to accept are just two different things. So that bid-ask spread continues to persist. And, for the best companies, time will help them, right? It's, the compounding of these assets potentially will get the sellers to the return they need from a multiple perspective. Obviously, the IRR will go down over time. And, assuming multiples stay the same, which I think we're, like you said, we're in a pretty healthy period right now. I don't see multiples going up. And if you're a seller, you've got to count on the asset continuing to perform. But we've been surprised a few times recently where sellers have not been willing to trade at what we would consider, very, very appropriate and perhaps even full market prices for good assets. So we'll see what happens. The best companies in software compounded organic growth rates that will allow investors to ultimately get their return. I think that's just the reality of the quality of these businesses. And then in the interim, they've also, all of these assets, whether we own them or others, they've been, consolidating markets and adding technologies and continuing to build their business. So, the deals from the deals from that time frame, given the prices paid, will just take longer, to get to the ultimate outcome. But the best companies will still be great investments. And that's one thing we love about software, right? You get long-term compounding returns, and ultimately, returns that are hard to get over the long run in some other industries, just given the nature of the businesses, the revenue quality, and the overall growth of these end markets over time. But you're right, there's still a bid-ask spread today, and that's due to prices paid, I think, for the most part.
It's interesting. Like, why do you think like there's never been that capitulation moment? Because I think there was a big expectation. You mentioned recurring revenue loans, right? And I think there was an expectation that like when those things trigger to, because for folks who maybe don't know about how these things work, like you say, generally that's a loan made to a company with like strong, sticky recurring revenue on the assumption that even if it's not profitable now, you can kind of cut to profitability later, right? And that there's sort of embedded cash flow there. And I think there was an expectation that when the terms on a lot of those loans requiring them to kick over to kind of like a cash flow based loan happened, you were going to see a bunch of people like maybe have to capitulate, but that kind of didn't happen. And then you also had just like, in the aggregate, the industry has had trouble returning cash to fund backers and all this kind of stuff. Like, why did none of it end up mattering?
These assets are incredible. I think in our industry, you're right. We all kept waiting for that moment where prices would just collapse and there would be incredible buying opportunities. And it just never happened. And I think for the most part, now look, there's been some assets that haven't worked out, right? That have just not been, that were just bad investments in general, regardless of if you bought them at the bottom of the market or the top of the market, it still would have been a bad investment. So, move those aside. But the great assets in software, regardless of sector, whether it's a cyber company or a vertical market business or a horizontal software company, the great assets are really, really hard to replicate as an investor. So if you own one and it's a great business, you're not going to sell it in the near term for a price that you don't like, especially given what you paid. And I think we're still seeing that today. Now, there's also assets that are unsellable. Companies that you could have bought for an amazing price, for the best price, for a great value, that just don't have a future. And those bad investments would have always have been bad investments. The great companies are so hard to replicate in your portfolio. They're hard to find. There's not that many of them actually at the end of the day. We're fortunate that we own and have owned a lot of them. But those assets you only part with for great prices and at the right time.
Got it. So like when you're thinking about the entries that you guys had maybe over that kind of 21, early 22 period, like have any of those, we're getting closer to the time when on a typical private equity timeline, you would have expected to begin seeing kind of like exits cold from that portfolio. And do you think for you guys, you're going to be keeping on pace for that? Are there any kind of like paradigmatic exits that you would point to that Thoma has had over the last few years that you're like, yes, that's the template? Or is it just inevitable that some of this stuff is just going to end up being a longer hold period?
Well, look, we, in that time frame, we bought SailPoint that went public earlier this year in February. In that time frame, we bought a company called the Denza that we have since exited to NASDAQ for an incredible return. So we've already started doing that. It's a little bit to my point that, when you focus on quality and great companies, there's always opportunities out there for exit, whatever that might be. Of course, the bar is really high to take a company public, but we do build assets that have a lot of strategic interest as well. And you see a lot of strategic buyers showing up in our portfolio. The investments from that time, when we look back, we're really happy with. The upside of there being a lot of transaction volume during that time period, and there really was, right? Like people were ready to pick up the phone. A lot of those companies were bought during the pandemic, where actually nobody had anything else to do. So we were as efficient as we've ever been. Those assets, arguably wouldn't have been available in other time periods to buy. And so, we look back, always the prices are higher than, what you want to pay really in any period. But the quality that we're able to, put into our portfolio during that time frame has really been exceptional. And, to the two that I mentioned before, you're starting to see, IPOs, you're starting to see strategic exits. And we're still obviously, quite early in that. So, now will some assets take longer to exit? For sure. That's just the nature of what we're talking about before, where you do have to compound your way back into the price that was paid. But if you go look at the market multiples today compared to at the time when we bought those companies, they're very similar. And that's because we buy companies on revenue for the most part, and then we always sell them on cash flow. And cash flow multiples really never changed. And in fact, I think today for many sectors, the cash flow multiples in the market are higher than where they were at that time frame, or at least the same. And with that mentality and with that investment strategy, We're not counting, on 50 times revenue multiples to hold. There was a lot of that going on during that time frame for the really unprofitable companies. That's really what's changed in the market. We always tried to buy a company at a reasonable recurring revenue multiple with the idea that we were going to sell it at a market cash flow multiple. And those cash flow multiples have held really, really steady over time. And a lot of companies were, and it's still the case in the public markets, are just not very profitable. Now more are, because I think the market has moved there. But the second the market decides it wants cash flow, it decides a month later that it wants growth, and we're sort of back in that world again.
Yeah. Yeah, no, it's interesting because when I think about it, like what you're describing is like the flip side of just like this very mechanical sort of deal pitch during the height of the SaaS kind of buyout era, right? Which was, again, you're taking all these companies that were in growth mode, even if you like kind of froze them in place today, stopped, and just like cut out the SG&A, you had like some sort of sticky cash flow that was buried in there that you were going to be able to bring out. Like obviously the actual plan's more complicated than that and so on, but like that's kind of like the fundamental.
I know you make it sound so, if it was only that simple.
But like what I do wonder is like the big question that everybody has, and you see this in the kind of public equity valuations of the likes of the Adobes and the Salesforces and so on of the world, is whether that same cycle is dependable and repeatable anymore in an era when people are asking not just, oh, do we have like a new class of competitor that's coming up in terms of like the corporate world, but also just like technologically, like, do you begin to obsolete certain classes of technology product? And, kind of in the AI cycle, I'm presuming for cybersecurity, where you do kind of a lot of your focus, it's going to create new threat vectors and there'll be new companies and so on. But just like for that kind of like standard SaaS playbook, like, does that change or weaken or have to evolve at all?
Well, I mean, it's a new consideration for sure, right? I mean, every company in our portfolio, any new investment that we're looking at, has a generative AI strategy. We have a really strong belief that incumbents are going to be big winners in this phase, especially in the enterprise, right, where they have incredible customer relationships. Enterprises trust them. We always talk to people about the fact that, sure, like maybe it is easier to build an app, right, with a lot of the Copilot coding tools that are out there. But then you got to build a business to support a Fortune 500, Fortune 1000 company. That relationship, customer support, process know-how, workflow know-how, that's pretty tricky to do, and much harder to do, as a brand new startup with, maybe, an application that's been built over a short amount of time. There's certainly some workflows in software that, we think are susceptible, that we won't be investing in. And you mentioned an area where there's a ton of tailwind, right? Cyber's a great one. Cyber and the threat landscape and the threat vectors, and what we're seeing in the market today, and the ability to now, need to manage and secure agentic and the agentic wave, which is still really, really early. We're seeing some massive market expansion in certain areas as well. So it kind of goes both ways. We've lived through these transitions before. Fundamental operating principles don't change as owners of businesses. And that's where, for us, you have to be partnering with innovators, because, we have companies generating over a couple billion of revenue in our portfolio, massive R&D groups. Those groups are, of course, not sitting still. They're still innovating. They're using all of this new technology that's out there. They're delivering value to customers. But you've got to you've got to be on your front foot. And as an investor, there's just another element now to really be conscious about and think about and invest in, in this wave that we're in today, which had come on pretty quickly, actually, relative to other cycles, actually.
Right. Yeah, no, absolutely. And what I kind of wonder is actually what that means in terms of its effect on not just the kind of technological shift, but also the market shift that we've seen since ChatGPT's release, right? Which is the effect on, I guess, the vintage of investments made in that sort of like immediate period where maybe we didn't all see like how significant the effect of ChatGPT and the whole wave that kind of came after that or anticipate, like how strongly markets would recover coming out of that slump. And so you had a bunch of deals maybe that were done, again, like very, very highly equitized, very low price tags, maybe, or more reasonable price tags or something like that. But like, I kind of wonder, like that weird, like tweener set of deals, like, do you think that looks different bringing those to maturity and through to exit eventually? Because I presume like along the way, folks will be doing stuff like, I presume there's a reason that we see like a ton of dividend recaps these days and so on. Like it's because folks are like managing those cap structures through to figuring out how to bring those back out, right?
I think you're seeing dividend recaps because the credit markets have been really good.
Right.
Right. Yeah. And you have a lot of companies that have grown quite a bit, generated a lot of cash flow, and have just been over equitized for whatever different reason. And so much of that is returning capital, while continuing to grow the business. At least in our case, there's always a need to return capital. We're very focused on that for investors, and we always take advantage of what the market gives us. So sometimes the market gives you the ability to return capital through dividends. Sometimes you have a great IPO market, or maybe there's a strategic buyer out there. Certainly when private equity was a really active buyer, we took advantage of that opportunity as well. So I think it's much more, when you see those types of events, it's much more about where the market is at the time. And you have companies from that time frame, because most of the capital being returned will be the deals that we talked about earlier. They're just ready. They've performed. You can only pay a dividend on a company that's performing really well, but the market is there today to do that. And that's not always the case, right? These credit markets, the pendulum swings all the time as well. The appetite to affect a dividend, in the market always, does that pendulum swings, and it just happens to be in a good spot today. And so when that's the case, we take advantage of it to return capital, through that mechanism as well.
Okay, so taking that as read for kind of those last two, like mini vintages, let's call them, of deals, like as we step forward over for the next kind of like 6-12 months, obviously there's like big picture risks from, does AI turn out to be overextended as an investment theme? Is there a pullback and so on? But like, do you see anything coming down the pipe that's going to change like structurally the way that you expect folks to be managing their portfolios or doing exits, or like any kind of like shift in the way you think about how you tap the credit markets or the way that you equitize deals? Because Thoma obviously has like a pretty sophisticated capital markets operation. And like you say, you guys have picked from the kind of private and public credit markets when you've needed. I'm just curious as to where you see this all shaking out, like especially if we do get kind of a AI mega theme kind of blow up.
There's a lot there. The one thing that's really worked well for us over time is sticking true to what we're very good at, which is just helping great businesses operate best in class, including growth, including acquisitions, innovation, really, across the board. I don't know, of course, what other people will do or how they'll react. I mean, we'll continue to focus on delivering liquidity, when we can. It takes a lot of time to find a buyer. That's a big change in our market, especially at scale. We spend a lot of time thinking about buyers, working with buyers, trying to find buyers, creating strategic rationale and business plans. That's changed over time. That is one change, actually, in the world that we're in today. The AI question is a big one. The way that we can control that is by investing in solutions for our customers and making sure that we don't miss innovation cycles. And of course, it'll come to play in decisions we make on the investment side. If we think that there's a company that either has missed a cycle, is really a risk, or just doesn't get it. It's all ultimately about leadership in these businesses. Great leaders figure, these elements out. AI is just another, another piece of the business to now manage. And if you weren't an innovative company before, or weren't a business that, was looking forward, you probably were behind in other areas anyway. So now you have AI to also think about I think the credit markets, are healthy, will stay healthy. And the nice thing today, we live in a world where, the syndicated markets and the private credit markets have coexisted for a while. Oftentimes the syndicated markets will be closed, and there's obviously a massive amount of private credit that can step in when that happens, and vice versa, right? Sometimes the syndicated markets end up just being healthier and better. Who knows what happens in the macro? That's always the thing in a messy world. You don't know what's going to happen next. We don't try to bet on that. We never take big guesses when we're making our investments. We try to control what we can control, and again, that's all about picking the right businesses, people, and then running them the right way, running the companies the right way with the right leadership. So there's a lot. I think that the world is more complex than it used to be. I think that we are sitting in the middle of a big technology shift, but I think the one thing that has continued to hold true for us is just operational excellence. Always wins. And taking a long-term view, and that's something that we're really good at.
Got it. Okay, well, for now, Seth, thank you so much for joining me on The Big View. Thanks
for having me back. Great to see you. Appreciate it.
That's our show this week. Thanks to Jonathan and Seth for that fascinating conversation, and as always, thanks to you for tuning in. This podcast was produced by Oliver Tasich in London and Pranav Kiran in Toronto. It was our last Big View of 2025. You'll be able to come back and listen to the Big View again in 2026 in January, every Tuesday, and you'll also be able to listen to our sister show, The Newsroom, every Thursday, as well as other great podcasts from the Reuters team. To get in touch with feedback, questions, and ideas, please email us at breakingviews-podcast@tr.com. That's breakingviews-podcast@tr.com. If you like what you heard, please rate the show and leave us a review, and check out our views on the biggest stories in business and finance every day at breakingviews.com and reuters.com.